Shares and debentures are two of the most popular investment options available in the financial market. These investment instruments allow you to invest in companies and potentially earn a return on investment. Understanding the differences between the two is essential to determine which investment option aligns with your investment goals and risk tolerance. In this video, we'll take a closer look at what shares and debentures are, the different types available, and the key differences between the two.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
What are shares? Shares represent a unit of ownership in a company. When a company needs to raise capital, it can issue shares to investors in exchange for their investment. Shares are typically bought and sold on stock exchanges. The investors who purchase the shares become part owners of the company and are referred to as shareholders. Shareholders have a claim on the company's assets, earnings, and profits. Types of shares. Common shares. Common shares are the basic form of ownership in a company. They give shareholders the right to receive dividends and vote on important company decisions, such as board members, mergers, and acquisitions. Common shareholders also have the right to receive a portion of the proceeds in the event of the company's liquidation. Preferred shares. Preferred shares give investors a higher claim on the company's assets and earnings than common shareholders. They have a fixed dividend rate, which means that the company must pay the preferred shareholders a set amount of dividend before paying any dividends to the common shareholders. However, preferred shareholders do not have voting rights. What are debentures? Debentures are a type of debt instrument issued by a company to raise capital. They represent a loan from investors to the company, which the company must repay with interest at a specified time. Debentures are usually unsecured, meaning they are not backed by any collateral. However, some debentures may be secured by specific assets or convertible into company shares. Types of debentures. Convertible debentures. Convertible debentures can be converted into shares of the issuing company after a specified period. The conversion rate is determined at the time of issuance and is usually based on the current market price of the company's shares. Convertible debentures are attractive to investors who want the potential for capital appreciation through ownership of the company's shares. Non-convertible debentures. Non-convertible debentures cannot be converted into shares. They offer a fixed interest rate and are considered a safer investment than convertible debentures. Secured debentures. Secured debentures are secured by specific assets of the issuing company. This means that if the company is unable to repay the debenture, the investor has a claim on the assets that are pledged as collateral. Unsecured debentures. Unsecured debentures are not backed by collateral, making them riskier than secured debentures. However, they typically offer higher interest rates and potential returns.
Before we proceed, here's the question for this week's $25 Money Opulence giveaway. What are the four main types of debentures? That's it. Pretty simple, right? Just leave your answer in the comments below, and you'll be automatically entered to win $25. The winning comment will see this as a reply, so stay tuned. Earn money while you learn about money with Money Opulence.
Key differences between shares and debentures. Voting rights. Shareholders have voting rights and can participate in the decision-making process of the company, such as electing the board of directors, voting on mergers and acquisitions, and approving major changes in the company's policies. Debenture holders do not have any voting rights and do not participate in the company's decision-making process. Returns. Shareholders receive returns in the form of dividends and capital gains. Dividends are a share of the company's profits paid out to the shareholders, while capital gains are the increase in the value of the shares. Debenture holders receive returns in the form of interest payments, which are typically fixed and predetermined. Risks. Shares are generally riskier than debentures because their value is subject to market fluctuations. The value of shares can rise or fall depending on the company's financial performance, market trends, and investor sentiment. Debentures, on the other hand, offer a fixed rate of return and are less risky. Priority in payment. In the event of liquidation or bankruptcy of the company, debenture holders have priority over shareholders in receiving payment. This means that debenture holders are paid before shareholders. Debenture holders are considered creditors of the company and have a claim on the company's assets. Liquidity. Shares are more liquid than debentures because they can be easily bought and sold on the stock market. Debentures, on the other hand, are less liquid and can be harder to sell. This is because debentures are typically held until maturity and do not have an active secondary market.
If you want to see more of these videos, please leave a like and subscribe to our channel. Also, be sure to leave a comment. We appreciate all comments and feedback from you.
Thank you so much.
That's more than enough to help us grow and sustain our production expenses. See you in our next video.